Why $50 silver just became the most dangerous price in history. The psychological significance of the $50 mark in the silver market cannot be overstated, representing not merely a price point but a historical barrier that has ruthlessly suppressed valuations for nearly half a century. For decades, this specific valuation acted as an impenetrable ceiling, a graveyard for bullish sentiment where rallies went to die in 1980 and again in 2011. However, what we are witnessing today, on this 19th day of November in the year 2025, is a fundamental shift in market structure, where the ceiling is aggressively transforming into a floor. We are no longer celebrating a fleeting spike that touches this level only to collapse under the weight of profit-taking. We are observing the calcification of a new economic reality, where silver sustains its valuation against a backdrop of deteriorating fiat currency. This is not just price action. It is a vindication for those who understood the long-term debasement of the dollar. Yet the market volatility we are seeing today suggests that this battle for a permanent valuation above $50 is entering its most critical and violent phase. To understand the magnitude of this moment, we must look back with a sober economic lens at the history of silver volatility, specifically the Hunt brothers squeeze of 1980 where prices surged but failed to close above $50. In that chaotic era, the intraday highs were driven by a panic that was ultimately unsustainable, creating a legendary peak of $49.45 that haunted investors for generations. Adjusted for inflation, that 1980 peak would represent a valuation well over $210 in today's purchasing power, highlighting just how suppressed the metal remains even at current levels. The market mechanism in 1980 was broken by regulatory intervention and margin rule changes, forcing a capitulation that scarred the psyche of the commodities market. Today, however, the drivers are not a single entity cornering the market, but a broad-based recognition of sovereign debt risks and monetary policy failure, suggesting that the current price levels are driven by organic fear rather than synthetic manipulation. Fast forward to the quantitative easing era of 2011, where silver once again approached this mythological resistance level, touching $49.79 before plummeting. That rally was fueled by the Federal Reserve's initial experiments with balance sheet expansion, leading investors to speculate on hyperinflation that technically manifested in asset prices rather than consumer goods. The tragedy of 2011 was the speed of the reversal. Silver failed to consolidate, and the subsequent bear market lasted for a grueling decade. The difference in late 2025 is the structural deficit in physical inventory, combined with a monetary policy that has run out of ammunition. While the inflation-adjusted price of the 2011 peak would be approximately $73 today, the fact that we are now trading firmly above $50 signals that the nominal resistance has finally been shattered, clearing the path for a challenge of real inflation-adjusted highs. The breaking news dominating the financial wires today is that silver has not only breached the $50 level, but is effectively building a fortress above it, trading at $50.76 as we approach the market close. This resilience comes despite a heavy pullback earlier in the session, a classic shakeout maneuver designed to dislodge weak hands and trigger stop-loss orders before the next leg higher. The ability of the metal to absorb a substantial sell-off and fundamentally reject prices below $50 is a technical development that arguably matters more than the new all-time highs reached earlier this month. We are seeing a 1% gain in silver prices today, doubling the performance of gold, which indicates that the poor man's gold is finally waking up to its high beta potential, acting as a leveraged play on the same macroeconomic forces propelling the entire precious metals complex. The catalyst for today's reversal and subsequent rally lies in the release of deteriorating United States economic data, which has drastically altered the calculus for the Federal Reserve's upcoming decisions. The latest figures indicate that the number of Americans receiving unemployment benefits has hit a 2-month high, with continued claims for jobless benefits rising to 1.9 million for the week ending October 18th. This is a critical threshold. When continued claims begin to trend upward with this consistency, It is historically a leading indicator of a recessionary onset that the Bureau of Labor Statistics can no longer obfuscate with seasonal adjustments. The rise in jobless claims is the smoking gun that suggests the labor market is cracking under the weight of prolonged interest rate pressure, forcing the Federal Reserve into a corner where they must choose between saving the dollar or saving the economy. This softening of the labor market has immediately impacted the interest rate futures market, creating a volatile repricing of risk as investors scramble to predict the outcome of the December Federal Reserve meeting. The probability of a rate cut in December has fluctuated wildly in the last 24 hours, moving from 46% to 50%, and currently settling around 48.9%. This near-even split in market consensus represents a profound state of uncertainty. The market is effectively flipping a coin on monetary policy, which is the definition of a chaotic investment environment. When the world's reserve currency issuer has the market guessing with 50-50 odds, capital flees to safety. And in 2025, safety is increasingly defined not by treasuries, but by hard assets with zero counterparty risk. Gold prices have responded to this uncertainty by bouncing off a one-week low, finding support as the probability of lower interest rates weakens the opportunity cost of holding non-yielding assets. The yellow metal is trading up over $20 to $4,066.60, a staggering valuation that would have seemed impossible just a few years ago. This price action in gold is acting as the anchor for the silver market. However, silver's higher volatility is on full display as it outperforms gold on a percentage basis. The gold-to-silver ratio remains elevated above 80, sitting specifically at 80.28. Which creates a massive arbitrage opportunity for value investors who understand that historical reversion to the mean would necessitate silver prices doubling from here if gold were to remain static. The broader economic landscape is being further complicated by the delayed release of crucial data due to the recent government shutdown disruptions, adding a layer of opacity to an already murky financial picture. Markets are anxiously awaiting the minutes from the Fed's last meeting and the delayed September jobs data, both of which will likely confirm the stagflationary thesis that has taken hold of the institutional mindset. The fact that we are analyzing delayed data in an era of algorithmic high-frequency trading creates a disconnect. The algorithms are trading on stale information, while the physical market is reacting to real-time shortages and demand shocks. This disconnect often leads to violent corrections, but as we are seeing, the dip-buying demand for physical metals is overwhelming the paper market's attempts to suppress the price. Institutional analysts are finally beginning to capitulate to the bullish reality, with forecasts from major banks like Deutsche Bank now projecting an average gold price of $4,000 an ounce for next year. This upward revision is not driven by optimism, but by the recognition of elevated official demand, meaning central banks are continuing their voracious accumulation of gold reserves to hedge against sovereign debt default. This official sector buying provides a strategic put option under the market. If central banks are buying gold at $4,000, it implies a floor for silver that is significantly higher than the current $50 battleground. Silver, being the industrial sibling of gold, will inevitably be dragged higher by this monetary gravity, especially as the supply-demand deficit in silver is far more acute than in the gold market. The specific record that we are monitoring today, and the one that carries more weight than a simple intraday high, is the number of consecutive days silver trades above the $50 mark. Looking back at the historical data, the volatility of 1980 meant that while prices touched $50, they never closed above it for any meaningful duration, making the current market behavior unprecedented. In 2011, the flirtation with $50 was equally transient. Therefore, the year 2025 stands alone in history. We have already seen silver stay above $50 for 9 consecutive trading days in mid-October, a streak that shattered all previous records of durability. This metric, days above 50, is the true litmus test of a bull market, because it demonstrates the market's ability to absorb profit-taking without breaking the technical structure. We are currently tracking a potential second record-breaking streak, with silver having maintained this level for several days following the recent dip, adding to a total of 17 trading days above $50 since early October. While the streak was interrupted by a brief dip below the line on November 17th, the immediate recovery back above $50 on November 18th and 19th confirms the buy the dip mentality is in full effect. The significance of 17 cumulative days above $50 cannot be ignored. It signifies a transfer of inventory from weak hands to strong hands at this new valuation tier. The longer the price consolidates in this $50 to $54 range, the more energy it builds for the next explosive move towards $75 or $100. The technical chart patterns are revealing a double top formation near the $54.50 level, a pattern that typically signals a reversal, yet in a hyper-bullish adoption phase, these patterns can often fail, transforming into consolidation flags. The first peak occurred around October 9th, and the second test of that high happened earlier this month. Traditional technical analysis would suggest a pullback to support is necessary, and that is exactly what we are witnessing with the test of $50. If this level holds as support, converting the ceiling of the last 45 years into a reliable floor, it validates the thesis that we have entered a new secular bull market where the old resistance levels become the new accumulation zones. There is a growing consensus among retail investors and newsletter writers that $50 is the new support, a sentiment that is dangerous if adopted too early but increasingly looks correct. However, as a prudent risk manager, one must acknowledge that a washout down to $40 is still mathematically possible, and perhaps even healthy to completely reset sentiment. A drop to $40 would represent a 20% correction, standard in secular commodities bull markets, yet the relentless bid we are seeing every time prices dip suggests that there is a massive wall of money waiting on the sidelines. This capital is likely terrified of missing the breakout, creating a FOMO dynamic that acts as a cushion against deep corrections. The geopolitical and fiscal backdrop for this price action includes a United States government that is running deficits which require the issuance of debt that the market is increasingly reluctant to absorb without higher yields. This fiscal dominance forces the Federal Reserve to intervene, essentially monetizing the debt, which is the textbook definition of currency debasement. Silver, being a hard asset that cannot be printed, is acting as a barometer for this loss of confidence in the Treasury market. When we see silver rise on bad economic news, it is because the market anticipates the Fed put, the inevitability of money printing to prevent a deflationary collapse. We must also consider the volume of trading occurring at these elevated levels. Unlike in 1980, where the volume was concentrated in the hands of a few speculators, today's volume is broad-based and global. We are seeing heavy participation from Asian markets, particularly on the Shanghai Gold Exchange, where premiums often lead the Western spot prices. The Sunday night market opens have become improved indicators of sentiment, with gap-ups in Asian trading sessions frequently setting the tone for the week. This shift of pricing power from west to east is a long-term trend that further supports the floor for precious metals, as Eastern demand is typically physical rather than derivative-based. The spread between the bid and ask price currently sits at roughly 12 cents, a relatively tight spread that indicates liquid market conditions despite the high volatility. This liquidity is crucial. It means that despite the high prices, the market mechanism is functioning correctly, and buyers and sellers are finding equilibrium without the liquidity gaps that characterize a bubble about to burst. A 1% daily move in silver, while significant, is becoming the standard deviation, suggesting that volatility is normalizing at these higher price plateaus. Examining the poll data from market participants, there is a strong bullish bias, with 63% of investors believing silver would breach $54 by the end of the week. While sentiment polls are often contrarian indicators, in a trend-following runaway market, the crowd can be right for extended periods. The fact that the majority expects higher prices creates a self-fulfilling prophecy where selling is withheld, drying up the supply side of the equation. If we can close this Friday above $50, it will mark another psychological victory, solidifying the weekly candle and setting up the charts for a run at $60 before year-end. The delayed nature of government data releases mentioned earlier serves as a reminder of the fragility of the administrative state. The government shutdown disruptions are not just bureaucratic inconveniences, they are symptoms of a dysfunctional fiscal system. Markets hate uncertainty, and when the government cannot even produce timely economic data, the risk premium for holding fiat currency rises. This institutional incompetence is a subtle but powerful driver for gold and silver, as investors seek assets that do not rely on government reporting or stability to maintain their value. The correlation between interest rate cut expectations and precious metals is nonlinear. While lower rates generally help gold, the reason for the lower rates matters more. If rates are cut because inflation is conquered, metals might stagnate. But if rates are cut, as the current data suggests, because the economy is collapsing while inflation remains sticky stagflation, then real rates remain negative and metals explode higher. The market is currently pricing in the latter scenario, a panic cut by the Fed to save the labor market, which will inevitably reignite the inflationary fires, making cash a guaranteed losing position. We are also witnessing a divergence between the paper price of silver and the physical availability of the metal. While the spot price battles at $50, premiums on physical coins and bars remain robust, indicating that the paper price is lagging the street price. This decoupling has been a theme for years, but becomes critical when prices break out. If the COMEX cannot deliver metal at $50, the force majeure event that many stackers have predicted could become a reality, leading to a rapid repricing where the spot price becomes irrelevant compared to the cost of actual acquisition. The concept of victory in this market context is redefining itself. It is no longer about getting rich quick, but about preserving purchasing power. A silver price of $50 in 2025 does not buy what $50 bought in 2011. Therefore, the nominal record is less important than the ratio of silver to other assets, such as the S&P 500 or real estate. We are seeing silver begin to outperform general equities, signaling a sector rotation from financial assets to tangible assets that could last for the remainder of the decade. Looking at the Fed Watch tool, the near 50-50 split on the rate decision indicates a paralyzed central bank. If they cut, they fuel inflation. If they hold, they crash the job market. This checkmate scenario is the ultimate bull case for silver. There is no good exit for the central planners. The volatility we see in the daily price action is simply the market vibrating as it realizes there is no safety net. In this environment, the only rational move is to own the assets that have survived every currency collapse in history. The resilience of the $50 level suggests that the commercial shorts, the bullion banks that historically take the short side of the trade, are either exhausted or have switched sides. If the banks are now net long or neutral, the capping mechanism that has frustrated silver investors for years is removed. We may be witnessing a free market in silver for the first time in decades, and a free market price for a strategic metal critical to solar energy, electronics, and military applications is likely significantly higher than $50. The industrial component of silver demand is providing a relentless bid that was not present in 1980. The green energy transition, mandating massive solar panel production, consumes a vast percentage of annual mining supply. Unlike gold, which is hoarded, silver is consumed. This industrial burn rate means that the above-ground stocks are dwindling. When investment demand kicks in, as it is doing now with the price breaking records, it competes with industrial users for a shrinking pool of metal, creating a classic supply squeeze. Let us address the support levels again. While $40 is the worst-case technical support, the behavioral support seems to be forming at $48. The buying pressure that emerges whenever silver dips below $50 is indicative of large institutional orders. These are not retail investors buying a few ounces. These are tranches of capital moving into the sector. This suggests that the smart money has already decided that $50 is a fair entry point for the long term. The narrowing of the gold-to-silver ratio, while slow, is persistent. At 80-1, silver is still historically cheap compared to gold. A reversion to the modern average of 60 to 1 would propel silver to nearly $68, without gold moving a penny. If gold moves to the forecasted $4,000 and the ratio tightens to 60 to 1, we are looking at $66 silver. If the ratio returns to the historic geological ratio of 15 to 1, the numbers become astronomical. We are currently in the early innings of this ratio compression. The narrative of transitory inflation has been dead for years, but its ghost lingers in the Fed's hesitation. They are terrified of repeating the mistake of the 1970s, where they cut rates too early and inflation roared back. However, the rising jobless claims are forcing their hand. This policy error, cutting rates into a sticky inflation environment, is exactly what triggered the 1980 run. History does not repeat, but it rhymes, and the rhyme scheme of 2025 is sounding very familiar to seasoned economic historians. As we anticipate the market close today, the ability of silver to hold $50.76 is a testament to the strength of the trend. A close above $50 today extends the days above record and invites more technical buying. The algorithms that run modern markets are momentum-based. As silver proves it can sustain these levels, the buy programs are triggered automatically, creating a feedback loop of rising prices. The implications for the average investor are clear. The window to acquire silver at double-digit prices may be closing forever in the coming years. Just as we look back at $5 silver as a relic of the past, we may soon look back at $50 silver as the opportunity of a lifetime. The volatility is the price of admission for the gains that lie ahead. The shaking out of weak hands is necessary to transfer the asset to those with the conviction to hold through the turbulence. In conclusion, the victory we are declaring today is not just about a price on a screen. It is about the durability of value in a world of eroding standards. The breaking of the consecutive days record above $50 is a statistical confirmation that the market has fundamentally changed. We are no longer in a speculation bubble, we are in a repricing event. Whether the Fed cuts rates in December or holds, the trajectory for silver is set by the inescapable math of debt and deficits. The $50 era is here, and for those who prepared, it is just the beginning. As we move forward into the rest of the week, watching the delayed jobs data and the Fed minutes, expect volatility to remain high. But remember, volatility is opportunity. The trend is upward, the fundamentals are undeniable, and the history of money is being written in real time. Silver is doing exactly what it was designed to do: protect wealth when the paper promises of governments begin to falter. The coming weeks will determine if we can solidify this $50 floor. If we see a monthly close above this level, it will likely attract generalist capital, money that has never looked at commodities before. This is the final phase of the bull market, the public participation phase, which typically sees the most explosive gains. Stay disciplined, watch the data, and recognize that we are living through a historic pivot in the global financial system. This is a time for vigilance, not complacency. The forces arrayed against the dollar are gaining strength, and silver is the primary beneficiary. The record-breaking streak of days above $50 is a signal flare to the world that the suppression is ending. The true price discovery of silver is finally underway, and the destination is likely far higher than the consensus dares to imagine. We will continue to monitor the spread, the claims data, and the Fed's maneuvers. But the signal is clear: silver has crossed the Rubicon. The psychological barrier has been breached, and the new paradigm of tangible assets is asserting its dominance over the decaying architecture of the fiat system. Ultimately, the value of silver is not measured in dollars, but in ounces. The dollar price is merely a reflection of the currency's collapse. As we break these records, we are simply witnessing the inevitable devaluation of the unit of account. The victory belongs to the patient, the prudent, and the prepared. The era of $50 silver is not the end, it is the new beginning. This market requires a steady hand and a long-term vision. Do not be shaken by the daily noise or the manipulated dips. The macroeconomic tides are turning, and they are lifting all boats that are anchored in real value. Silver's time has come. As the week progresses, keep a close eye on that $50 line. It is the line in the sand that separates the old world from the new. We are witnessing history, and we are positioned on the right side of it. The breakout is real, the support is building, and the future is silver. The path to three-digit silver is paved with these daily victories. Each day above $50 adds a layer of concrete to the foundation. We are building a skyscraper of value, and we have only just finished the ground floor. Stay the course. The confluence of technical breakouts, fundamental supply deficits, and macroeconomic chaos creates the perfect storm. Ride the wave, understand the risks, and appreciate the historic nature of this move. Silver is not just breaking records, it is breaking the chains of price suppression. Final thought: when the history books are written about the financial transition of the 2020s, this period, late 2025, will be marked as the turning point. The moment silver reclaimed its monetary status. The victory is ours.